Hello and welcome to Switzer TV. I'm Paul Rickard, filling in for Peter Switzer, who's up in Cambodia, but we don't have the communications to get Peter involved today, so you've got me. Anyhow, a really good program ahead of you tonight. I want to really probe into one question. We saw a big correction in the banks last week, followed by a rally today. Things like NAB are off something like about 15%. So I'm really going to focus on that question with my two investment experts. First of all, Adam Dawes from Shaw and Partners. Let's just find out what he thinks about the banks. Is the correction over? Is the correction still happening? Also look at some goings on in the market today with companies like WiseTech. And then the Chief Investment Officer at Vertium Asset Manager, Jason Taser along. Jason has been bearish in the banks. Want to get his take on it, but also look at some of the other stocks that have impressed him during reporting season. Joining me now is Adam Dawes. Adam is one of the senior investment advisors at Shaw and Partners. Adam, welcome to the program.
Great to be here. Thanks so much.
Very busy market, but let's just start. I guess what a lot of investors are thinking about is about the banks. Last week we saw quite a big correction. Some of the banks down almost 10%. CBA I think dropped 7%, but it's bounced back today. CBA up 3%, and ANZ and Westpac each up close to 2%. So was last week the correction in the banks that we had to have, or was last week the start of something a bit more fundamental in terms of a bit of a price drop, in your opinion?
Yeah, it's interesting, isn't it? Because you look at the banks and they've literally been bulletproof for the last 6 months. No matter how much mud, no matter how many analysts tried to tell you to sell it, all of those kinds of things, the banks just kept moving forward and increasing in their share price. But obviously last week we've started to see a little bit of a chink in the armor in the banks, and I think NAB was the one that was down about 15% as well. So that's a big move for one of our big fours. And obviously, I thought NAB's result was probably the weakest in the quarterlies. CBA didn't report, but through the others, I thought that was probably the weakest one, with their business banking section looking still fairly weak. So look, overall, I mean, it's great to see some heat coming out of these things. It's just been, as I said, it's been bulletproof. I'm starting to warm clients up to starting to buy some of the banks or getting back into the banks. Very hard to get a client to sell the banks, let alone getting them to do anything else. But I do feel that there's potential there, that the banks do look quite good at these levels. I'm liking Westpac. I thought Westpac's result was probably the best out of all of the bunch moving forward. So I like Westpac. I think that looks pretty good. Obviously, CBA is in the quality area, and that's certainly why it's probably leading the charge today on the rebound going forward. And in fact, it didn't fall as much or as hard, and it had paid a $2.50 dividend inside of all of that as well. So yeah, look, I think the banks are starting to look a lot more attractive. But Paul, you and I remember the days when there used to be an 8% dividend handle on these things, plus franking. And I think that's where we're going to need to get to before we really start to see some real support in the banking sector at the moment.
I mean, I've been pointing out to people that before sort of last week's little change in numbers, CBA was trading on a forward multiple of 27 times, and CSL was trading on a forward multiple of 25 times. Wow. CSL's growing revenue at about 5 or 6% per annum. CBA is 1% or close to 0%.
Yeah.
Totally out of alignment. That compare that, say, a couple of years ago when CSL was in the mid-30s and CBA was in the high teens. So they look super expensive to me, but I've also said that until you get the market wanting to invest in the resource companies, it's going to be really hard to get institutions to get out of the banks. And I don't think we're there yet. The resources are still really struggling. Is that the way you read it?
Yeah, look, I agree. Obviously, the dividends have started to be reduced. We certainly saw BHP, Rio, and Fortescue all reduce their dividends. Now, you don't buy a resource stock for dividends, that's for sure. But certainly the resource stocks are coming under a lot of pressure, especially in the iron ore market. Iron ore is certainly holding above that $100 mark. But we know we've got West Africa, Simandou, coming online midway through this year to end of this year, and they'll be doing up to 100 million tonnes of iron ore. Now, that's certainly good high-grade stuff, but that does put pressure on some of our miners as well. The miners definitely need to do a lot of the heavy lifting this year because the banks did it last year to keep our index moving, and we're just not seeing that heavy lifting coming through. So it does mean that our market might stagnate a little bit unless the banks decide to go for another run and more institutions try and pile in and sort of take it higher. But I don't see those institutions getting in there too hard as well, because we know that the forecast for the banks is pretty much 0 to no earnings growth for the next coming couple of years. And that's pretty hard as an investor. They've got to keep up with the index, but as an investor, it's pretty hard to justify putting money to work in something where there's 0 earnings growth.
Now, we're in the final week of reporting season. Most of the major companies have done. We've got Woolworths and a couple of other big ones this week. Got a lot of smaller companies. What's really struck you about reporting season so far? Any highlights that you'd like care to nominate?
Well, look, Telstra. I mean, look, one of those sleepy companies that, hasn't been doing much from sort of $3.80 and really packing a punch over the last coming couple of days. So I think that was a really good result. And looking further into the details, they are moving from strength to strength, especially in their handset division and those kinds of things. So I thought that was a really good result. I was actually really pleasantly surprised about the consumer discretionary stocks. Not that they powered ahead, but it did show that the consumer is still very resilient out there. Well, there's a lot of talk about all this hurt, pain, all of these kinds of living cost crisis, all those kinds of things. But the numbers that are coming through from Nick Scali, JB Hi-Fi, Lovisa today really showed that, look, it's still tough, but the people are still spending and the economy is still moving. And so, I thought that was a really good highlight. But look, the tech space is the one that I've, really happy with, as well as Telix. Probably Telix is my favorite of all of the results. That one has been a great story for us and continues to be a really good story. So, yeah, really comfortable. So there's a couple of outstanding ones in there.
Just tell me a bit more about Telix. I don't know if it's a company a lot of our viewers are familiar with. Just wanted to just expand on Telix a bit more.
Yeah, so it's just moved into the ASX 100. So you're getting a lot of that index buying coming through. But it's basically a biotech, and it's got a lot of drugs that that cancer, kidney, liver, those kinds of things. The reason why Telix has done so well is it's got patents on all of these drugs moving forward, but they've got a lot of revenue that's coming through as well. And in biotechs, it's either binary. They've got one drug, it's going to make it or it's not going to make it, that kind of thing. Whereas Telix has got a portfolio of drugs. They've got revenue coming in the door, and they're attacking that US market as well. It's definitely one to keep an eye on, and definitely one to do some research on. TLX is the stock code.
Right. Interesting about your comments about some of the consumer discretionary stocks, because they haven't done so bad. I thought the super retail result, market sold off, wasn't as bad as it looked, but it's got Woolworths up today. Wesfarmers wasn't too bad. As you say, the consumer is still pretty strong and continues to spend. And I guess we'll get that'll see whether, I think Harvey Norman's out later this week, whether that follows on. One I can't let go, of course, is off about 20% today. Been a bit more, of course, is WiseTech. 4 independent directors have resigned, thrown it back to the founder and co to run the company. All sorts of governance issues, more scandal stories in the papers today, and a bit of an earnings downgrade. So I guess a lot of people are saying, WiseTech below $100. Is it a buy?
Oh, look, I mean, you're right. The earnings downgrade, I mean, it was in line with expectations. So I think, you're right. It was at the lower end. So, for a growth style company that we've enjoyed for years and years, just hitting above those earnings lines and just outstanding results, it is a bit of a downgrade, and it is a sap of confidence. I think this time around, we've seen this fall previously. This was last year, and we had all these issues with Richard White, and then the market rallied straight away, straight back up again. I don't think we're going to see that this time. I think that people are going to be treading a little bit careful, and they're trying to understand the business going forward. The reason why, I mean, if you hold it, you're probably okay to hold it because of those earnings numbers. But for anybody else, if you're looking to put some money into this thing, it's a really tough space, because all of these directors, one, resigning, but then the infighting that must be happening on the board means they're taking their eye off the business, and they're not they're not growing the business. They're worried about lawsuits. They're worried about all the paper article, AFR and the Sydney Morning Herald articles and those kinds of things. So I just think it's something you got to be really, really careful with. I think there's potentially some more downside to this because of the reputational damage. We saw it last time bounce. I think this time people are going to be once bitten, twice shy. It's going to be a lot harder for this one to move forward. Look, if you hold it, hold on. I think you can be okay. But new, fresh money, I think it might go a little bit lower from here. So it's going to be interesting. I mean, I bought some for clients at 95.50 this morning. You know, they're more happy to sort of take a punt than an investment. And that's the problem. I think it is more of a punt now because we just don't know the outcome to what's going to happen with the directors and how Richard is going to deal with this company moving forward.
I think that's really good advice, because what you is sort of perhaps not as obvious is, of course, it's the clean skin directors who've resigned, left it with Richard and I won't say his cronies, but a couple of people close to him. This fund, WiseTech's held by every super fund in Australia. They've all got governance requirements. They've got to find a new board, bring a whole lot of new directors on, and I'm sure they're not going to be happy with the governance part. So, you know, it's going to raise a lot of issues with some of the big funds. Are going to say, well, we're not sure we can hold this. So I think you're right. I think this has got a little longer to play out. So maybe it's a buy for a trade, but you'd have to be careful on this one. I don't think we're going to quite see the same bounce as last time.
No, longer term, I think this one is going to go lower. And it's a really good point. There's very large institutions that hang their hat on ESG, environmental, social, governance. Governance, that is the last of the three. So if they can't hang their hat on that governance, they're going to have to move out as well. And that's going to be a tough one for WiseTech and the share price.
And finally, without notice, you may not have had a chance to look at this, but APA reported this morning, and the shares are up 7% off an incredibly low price. Any comments from you on that one?
About time.
I almost prayed too, I think.
We were talking on the desk this morning, so without notice, I think there's a little bit of short covering going on in this one here because it wasn't I mean, look, it is still a decent result. You would have thought APA would start to move now with interest rates starting to fall. I mean, that's that whole sort of bond proxy kind of business, and as interest rates fall, debt becomes less, or it becomes more cheaper. So, yeah, I think it's a bit of short covering. I think it's about time. I mean, that one's been hurting. I've got a lot of clients in this one at $8, which was very comfortably trading at for many, many years and very, very stable, good dividends, those kinds of things. But a little bit of short covering. So I'm happy. I really want to see this thing keep moving on because it is probably one of our last of our best infrastructure stocks on the Australian Stock Exchange. So it is good to see that we're starting to maybe see some green shoots, just a little bit of green shoots coming out on that one. But yeah, a little bit of short covering, I think, today.
Well, you just got to deliver on your guidance, and the market was happy. So the stock that was yielding over 8%. I haven't checked the calculation today, but it's certainly been in the high yield category. Good to see a bit of a bounce there. Look, as always, Adam, great to talk to you. Thank you for your insights. And I think some really sage advice, not just about WiseTech, but about the banks. I don't think we've started to see a big correction in the banks just yet, but time will tell. Okay, that's Adam Dawes. He's the Senior Investment Partner at Shaw & Partners. Thanks for joining us, Adam.
Thank you.
Joining me now is Jason Tay. Jason is the Chief Investment Officer for Vertium Asset Management, one of the managers or the manager for the Switzer Dividend Growth Fund. Jason, welcome to the program.
Thank you for having me, Paul.
Look, a question on many investors' minds at the moment is, are with banks, and have we started to see the correction? Last week, we had quite a big sell-off in the major banks. National Australia Bank down about 15%. I think we saw Westpac 8 or 9%, CBA 7%. But yet, today, we're seeing the banks go back higher again. Do you think last week was the start of the correction, or is it just sort of some of the rotation going through reporting season that we've seen some of the volatility?
Oh, look, I mean, it's a hard call, I guess, trying to call it from a short-term perspective. We'll find out in 6 months' time whether this short-term correction is sustained. But there's one thing very clear about the banks from where they have come from a month ago to where they are now. especially CBA, they're on record multiples, right? So, last year, the banks put on close to 30-40% total returns with just a little bit of earnings growth, not much in the scheme of things, which is not bad considering credit quality is still pretty good for most of the banks, and there's a little bit of loan growth. But the PEs are so high that small downgrades, such as what Westpac and NAB reported, results in big outsized move in stock price movements. So like you said, NAB was down 15% just for a small downgrade. So if they don't hold up their earnings, any more small downgrades would be punished severely. I guess in the future months, but time will tell.
And of the, we saw a full result from CBA, a couple of quarterly updates from NAB and Westpac, and ANZ a little bit of an announcement. Has there been anything that's impressed you in the result of any of those banks so far?
No. I mean, look. I think credit quality looks okay at the surface. I mean, you think about how stretched the consumer is, and everybody's complaining about the cost of living pressures. It's amazing how banks haven't seen further deterioration in credit quality. So look, I mean, to be honest, that's been a positive surprise over the last 6 months, definitely. So that hasn't deteriorated much further. But like I said, it's really not about earnings. The earnings really aren't moving so much. It's the massive PE re-rate they had last year, and it's possibly unwinding at the moment.
Yeah. And so do you think the whole market looks pretty expensive? I mean, Australia, it's very hard, I guess, the Australian market to go down when other share markets, global markets, US, UK, most of Europe, Japan's had a good rally. They're all sort of towards, record highs. But given our earnings outlook, it's hard to see why the Australian market is where it is. But do you think that's sort of we should be a bit more careful about Australia because of the lack of earnings growth?
Yeah, so obviously with the banks, they're about 20% of the markets. Our composition of our market is very different from overseas markets. So you sort of touched on the fact that there's a lack of earnings growth, and obviously there's not a lot coming through from the banks. And obviously the way you're going to make returns on the banks was either PE re-rating this year, and maybe there's a PE de-rating this year. So without strong earnings growth, you can't really offset any potential PE de-rates, which the banks may have this year. So but by saying that, there are sort of pockets of value in the market. So there are stocks still growing, at high single digits or low double digits. And one that used to be a share market darling, but I guess it has sort of the share price has been a bit lackluster over the last couple of years, has been CSL. So, for example, here's a stock that's obviously high quality in nature, historically has been double digits, and it's trading on a lower multiple than CBA.
Yeah,
And
a bit crazy, right, isn't it? Yeah, I was looking at that. I mean, I think CSL's on a multiple of about 25 times and CBA's on about 27 times, which is just unheard of. So let's talk about CSL. It reported, I guess, within expectations. The market got a little bit negative on sort of their influenza vaccine business, Seqirus, but the key sort of blood plasma division, CSL Behring, that seemed to hold up pretty well, didn't it?
Yeah, so basically, I guess there's three businesses to CSL. There's the plasma business, V4, which was the recent acquisition, and the flu vaccine business, which is Seqirus. But in terms of the biggest driver of earnings is actually still plasma, right? The old CSL that we used to know is still plasma is still driving the biggest proportion of its earnings profile. So that's solid, right? So I guess coming out of COVID, you had very low margins, and it's continues to actually perform quite well with margins improving and solid volume growth. So what tarnished this result a little bit, this result was actually Seqirus in terms of the softer volumes. But look, I mean, to put it into context, it is a smaller proportion of its business. So you are buying CSL for its plasma. So, and especially the fact that you're buying this business kind of like on 5-year lows from a PE perspective is actually a good foundation to actually generate strong returns in the future.
And around $260 is that a value transaction for you to look at CSL at this price?
Yeah, yeah, especially, I mean, I guess the trick is for the stock market is try not to overpay versus the earnings profile for a company. And given that the CSL is trading, I guess from an earnings growth perspective, it's low double-digit growth on, 25 times, give or take. It's actually a good price or good value for that type of earnings growth profile.
Okay, let's pick on another company that's fairly significant in your portfolio, and I believe reported pretty well, and that's Mirvac. Not a company I get a lot of questions on, I have to say. I don't think it's that widely held from a lot of retail investors, but maybe before you go to what you like about Mirvac, just a bit more about the company itself.
Yeah, so the Mirvac is a staple REIT. So as a staple REIT, obviously it owns property, receives passive income, but because it's also stapled to a residential, I guess, development company as well. So roughly about 20% of its earnings comes from residential developments, and if you think about the preeminent I guess apartment builder in Australia, it's actually Mirvac. Mirvac's apartments command a premium in the market, and last couple of years it's actually had some issues in regards to costs, but that's been cleared out. But you are buying Mirvac in terms of the volatile part of the earnings. It is the residential earnings, and the rest of the business is a passive REITs business, passive rent business. So the trick about with any REITs, obviously you want to buy value, trying to buy below NTA. So that's a good start. But also with Mirvac, you also got to understand how where you are in a residential cycle as well. So you obviously don't want to overpay when everything looks rosy, and at this point in the cycle, I think you could be underpaying compared to the value of the business. So
And is the cut on interest rates by the RBA that potentially should help a company like Mirvac, particularly if there's more to come?
Yeah. So that's certainly a big driver in terms of I guess property investment. So with rates being lowered, it increases the affordability of I guess investors or homeowners buying Mirvac apartments. And once that occurs, Mirvac's earnings typically improves. But before you normally see the earnings, the share market normally runs ahead of it. So I think the last time when you think about how long this current rate cycle has been on pause, and this is the first rate cut we've seen since since quite a while ago. The last time we've experienced, I guess, a long pause with the first rate cut was actually in March 2019. Actually, in fact, happened 1 year before COVID, right before the world stopped. But during that time, before earnings for Mirvac picked up, associated with the residential boom, the share market got a little bit more excited about it. So the share market tends to be a forward-looking mechanism, and Mirvac experienced a PE re-rating around that time to reflect the positive sentiment associated with the residential.
And you're seeing a good chance for PE re-rating at the moment. Is that what you're looking for?
Yes, yeah. So in fact, two things. Mirvac, currently has depressed earnings. So last year in August, they came out with a earnings downgrade associated with margin contraction associated with a residential business. They did say going forward that will not happen again because they will price all future projects to take into account some of those uncertainties. So with the prospect of just earnings recovering to where it was before and the added stimulus from an RBA cut and potentially more in the system, we should see stronger earnings eventually. But I guess in the shorter term, the PE of the company re-rating as the share market, I guess, turns itself towards some of these residential players.
Okay. Let's move on to another company, different field. Brambles, of course, the leader in the logistics area, particularly with their pallets. Brambles has reported pretty well. Shares are trading close to record high, but you just want a company. I think you've also got quite a big position in. You want to just comment on about Brambles?
Yeah, so there are a few companies. In fact, two companies coming to mind. In fact, they're both in the top 5 positions. Two companies that have done really well post-COVID is Brambles, and the other one is QBE, which we could talk to afterwards as well. So when you look at Brambles and QBE, both have been beneficiaries from very strong earnings post-COVID, right? So Brambles benefited as they put in price increases, and in the post-COVID, well, those prices are stuck. Actually, they haven't reversed. So was $1 million question is whether the earnings will come off as those price increases, which was put in place a few years ago. And so far to date, Brambles have shown pricing power, and those prices have stuck. The key to Brambles as well, in the post-COVID world, they just run more efficiently. So in terms of free cash flow, the company has never been more efficient in terms of producing the amount of free cash versus the dollar revenue they receive today. So from a free cash flow perspective, Brambles is actually very cheap, right? From a value or price to free cash flow, it's actually one of the cheapest multiples. I mean, if you compare it to itself through history, it actually generates quite a lot of free cash versus how much you're paying for it. So, so from an earnings perspective, earnings is actually holding up quite well. Free cash flow is actually, very, very healthy compared to where it was pre-COVID. So because the business has transformed in terms of where they manage the capex and the maintenance capex to generate that much free cash. There will be a point in the future where Brambles will embark on, a buyback because its gearing levels are dropping every year.
Yeah, I think the market was, as you said, was quite surprised that it could put through those price increases. I think they were foreshadowing if Brambles tried to lift its prices, it would lose share. In fact, it's held all its share and probably gained some. So showed it has real pricing power. Another company that's got pricing power, as you mentioned, is QBE. They also seem to report, or at least the market seemed to like their report. What's your take on QBE at the moment?
Yeah, so QBE is a company that's actually been in a portfolio a while, but we actually increased it not that long ago. And you think about the earnings profile for QBE post-COVID. Look, the whole industry suffered during when commercial property or just general businesses were closed. So and because of the large insured losses during COVID, it set off a strong insurance cycle around the world. Right, and QBE benefited from that, from gross written premiums rising quite dramatically from higher insurance prices. Now, to put that into context, COVID cost the industry about $40 billion. So during the LA fires, which was probably a month ago or 6 weeks ago, right? Estimates were coming in that it was going to be around $20 billion. Now it's settling around $30 billion. So this is such a large event, the biggest wildfires ever to be recorded in California. It's going to cost the US industry about $30 billion, right? So fortunately for QBE, they have reduced their market share in California over the last few years. So it's not going to be hit with claims. So that's a good thing. The other good thing is that they're still exposed to the US insurance industry. And guess what? Every other insurer is going to do in the US. They're going to raise prices to recoup the $30 billion. Right? So that's why during that LA fire incident, look, as bad as it was, as in fact, the best time to buy insurance companies is when there's a crisis. As long as the position's fine, and obviously, like I described with QBE, it was not really much of a claims issue. Capital position is perfect, and they'll ride along with the rising insurance premium that will most likely come along in the next few years in the US.
Well, Jason's mentioning comments about two companies with genuine pricing power in terms of both QBE and
Brambles, yeah.
Brambles, sorry, yeah. And then also your comments about Mirvac. And I do think on the banks, you're probably right. I can't see the big correction just yet, but let's at some stage the market's going to see common sense. But these things often take a lot longer than we think. So that's where I think we are at the moment. That was Jason Tay, the Chief Investment Officer at Vertium Asset Management. Thanks for joining us, Jason.
Thank you for having me.
Well, I think that was some really important advice about how to play the banks. I don't think there's a major sell-off coming just yet, but it will certainly take the market to want to get excited about the resource companies, in my opinion, to start to exit the bank stocks. That's all for this week. Peter will be back next week, next Monday. We'll see you then. Goodbye for now.